What if one of the biggest reasons you may never build serious wealth isn't that you don't earn enough, but that your money isn't working hard enough? You wake up, go to work, get paid, pay your bills, send money home, and whatever is left sits in your bank account. Some investors are putting their money in hundreds of companies at once without having to buy hundreds of stock individually. One of the easiest ways they do this is through something called an ETF. And if you are trying to build wealth over the next 10, 20, or 30 years, understanding ETFs could completely change how you think about investing. So today, I'm going to explain exactly what an ETF is, how it works, how you can make money from it, the risks, and how a beginner can get started. ETF stands for Exchange Traded Fund, but forget the complicated definition for a moment. Think of an ETF as a basket of investments. Imagine you have 1,000 Ghana cedis. You could take the 1,000 Ghana cedis and buy shares in one company. But what happens if that company performs badly? Your investment can take a serious hit. Now, imagine instead of that, your 1,000 Ghana cedis gives you exposure to dozens, hundreds, or even thousands of companies. That's the basic idea behind ETFs. Instead of putting all your eggs in one basket, you are buying the basket. And the interesting part, you can buy and sell many ETFs on a stock exchange just like you would buy and sell an individual stock. Here is a simple example. Let's say there's an ETF designed to track the SP 500. The SP 500 represents approximately 500 large US companies. Instead of trying to individually research and buy 100 of companies, an SP 500 ETF can give you exposure to that broad group through a single investment. So your investment isn't dependent on whether one particular company succeeds. You are spreading your exposure across many companies, and that's one of the biggest attractions of ETFs: diversification. With that, you may wonder, why should you care about diversification? Let's say you put a 10,000 Ghana cedis into one company. That company experiences serious problems. Its stock falls by 40%. Your 10,000 Ghana cedis could become roughly 6,000 Ghana cedis. Now compare that with an investment spread across hundreds of companies. One company having a terrible year doesn't necessarily destroy your entire portfolio. That's because you are not dependent entirely on one company. But understand this, diversification does not mean you cannot lose money. If the overall market falls, an ETF tracking that market can also fall. The goal is not to eliminate risk. The goal is to avoid unnecessary concentration in a single investment. There are generally two major ways you can make money from an ETF. Number one, capital appreciation. You buy an ETF for a certain price. If the underlying investment increases in value, the ETF's price can also increase. For example, you invest 10,000 Ghana cedis. Over time, the investment grows to 15,000 Ghana cedis. That's a 5,000 Ghana cedis increase before considering fees, taxes, and other costs. Number two, dividends or distributions. Some ETFs hold companies that pay dividends. Depending on the ETF structure, those distributions may be paid to investors or reinvested. And this is where long-term investing becomes interesting. You are not simply relying on your salary. You are trying to build assets that can potentially grow alongside your income. You may wonder, can an ETF be a powerful tool for beginners? Here is the problem with traditional investing. A beginner hears invest in stocks. Then they ask, which stock? Apple, Microsoft, Amazon, Nvidia, Tesla, a Ghanaian company, or a Nigerian company. And suddenly, investment feels complicated. But ETFs can simplify the decision. Instead of trying to identify a single company that will become the next giant, you can choose an ETF that gives you exposure to a broader market or a specific investment theme. That's why ETFs can be attractive for people who want a more diversified approach. There's one thing you must note. There isn't just one type of ETF. This is where things get interesting. There are ETFs that focus on different areas. Stock ETFs. These invest in groups of companies. Bond ETFs. These provide exposure to bonds and fixed income investments. Commodity ETFs. These can provide exposure to commodities such as gold. Real estate ETFs. These can give investors exposure to real estate related companies or assets. International ETFs. These can provide exposure to companies outside your home country. Sector ETFs. These focus on specific industries such as technology, healthcare, energy, or financial services. So when someone says, I invest in ETFs, that doesn't tell you everything. You still need to know which ETF and what it actually owns. But here is the most important part most beginners miss. An ETF is not automatically a good investment just because it's an ETF. You can still make terrible investment decisions with ETFs. Imagine buying an ETF simply because somebody on TikTok said this ETF is going to make you rich. That's not investing. That's speculation. Before buying an ETF, you should understand, what does it invest in? What index or strategy does it follow? What are the fees? How diversified is it? What are the risks? What currency is it dominated in? How liquid is it? How does it fit your financial goals? Don't buy something simply because it's popular. Another thing you need to know is that ETFs aren't free. Many ETFs charge an annual expense ratio. For example, suppose an ETF has an annual expense ratio of 0.20%. If you had the equivalent of $10,000 invested, the annual fund expense will roughly be $20. Although the actual effect depends on how the fund's assets change and how the fees is collected, the percentage may look tiny, but over decades, cost matters. That's why investors should pay attention to fees. Small percentages can become big amounts over long periods. I know by now if you are in Ghana, you are wondering, can I invest in ETFs? Potentially yes, but access depends on the brokerage or investment platform available to you. If you are in Ghana and considering foreign ETFs, you always need to think about currency conversion. You may earn and save in Ghana cedis, but invest in an ETF dominated in another currency. That introduces currency considerations, currency conversion costs, taxes, regulatory requirements, withdrawal procedures, ETF availability, platform security, whether the broker is properly regulated. Don't send your money to an investment platform simply because someone on social media recommended it. Do your due diligence first. The real power of an ETF is time, and this is probably the most important lesson. You don't need to become rich overnight. In fact, trying to become rich overnight is exactly what gets many people into financial trouble. The bigger opportunity is consistent investing over a long period. Imagine someone invests 500 cedis every month. That's 6,000 Ghana cedis a year. Over 20 years, they've contributed 120,000 Ghana cedis before considering investment returns. Now, imagine that money has also been invested and compounded over that period. The final amount could potentially be significantly higher than the amount contributed. That's the power of giving your money time to grow. Of course, investment returns aren't guaranteed. Markets can rise, markets can crash. Some years can be terrible, but long-term wealth building is usually about consistency, not trying to predict every market's movement. But don't also think ETFs are a guarantee that you will become rich. Absolutely not. And I want to make that very clear. There is no legitimate investment that can guarantee you will become rich. An ETF can lose money, markets crash, companies fail, currency fluctuates, and past performance does not guarantee future returns. But here is the bigger lesson. If you never learn to invest and your money remains completely dependent on your salary, you may be making wealth building much harder than it needs to be. Your income pays for today. Your investments are designed to help you build for tomorrow. The biggest mistake isn't necessarily choosing the wrong ETF. It's never starting to learn about investing at all, because time is an asset. Someone who starts learning at 20 has a very different opportunity from someone who waits until 40. Someone who starts investing consistently at 25 potentially gives their money decades to compound. That's why you shouldn't wait until you are rich before learning how to invest. Learning how to invest is part of the process of becoming financially stronger. So let's go back to the question. What is an ETF? An ETF is essentially a fund that can hold a collection of investments and trade on an exchange. It can give investors diversification, convenience, and access to different markets and asset classes. But ETFs aren't magic. They won't automatically make you rich. What they can do is give you another tool for building long-term investment portfolio. And if you are serious about financial freedom, you need to understand tools like this, because the goal isn't simply to earn money. The goal is to eventually have money working alongside you. If you found this video useful, subscribe to Money Code Africa. Turn on your notifications so you never miss my new videos, because we are breaking down investing, stocks, ETFs, businesses, and wealth building strategies in simple language for Africans. And thank you for watching. And as always, I'll see you in the next one.